Good afternoon, everyone. If you guys are here to learn how to raise capital, if you hear how to syndicate and to learn about self-storages, we're definitely in the right room. Today, I have a treat for you. I'm going to be here talking with Fernando Angelucci. I learned a ton from this guy. We go way back when, I think buying houses. Actually, I bought a couple homes from him. And then he transitioned to self-storages, which I learned a ton from this guy too. We've done a couple deals together, and then he just went all in. I was always watching him from the sidelines. We connect once in a while. In fact, I haven't talked to him for probably a year. I think last time we had a lunch, so we're in
Yeah.
Bronzeville about a year and a half ago, right? And he's always on the go. He's always full of a lot of information, always sharing, always giving. And I'm really, really excited to share that knowledge with you guys. And whoever's going to stay here till the end, I can assure you're going to learn how to raise capital, how to syndicate, and you're going to know a lot more about raising capital. So, with that, Fernando, I would like to start with a question. Tell me a little bit about yourself. How did you start from housing and transition to raising lots of capital and self-storages? And then I'm going to lean to the capital raising questions.
Yeah. So, son of two immigrants, they,
We lost you for a second, Fernando.
oh, can you hear me now?
Yeah, now we're good. Yeah.
There we go. Yeah. So my parents are immigrants. They had the old school American dream kind of laid out for me. So go to school, get good grades, go get some type of professional degree, and then retire in 40 years of the pension. Obviously, that didn't work out the way they wanted. When I was 16, I read Rich Dad Poor Dad, and then basically realized that I wanted to be a business owner and a real estate investor from that time on. So very, very quickly, right out of school, I started flipping houses and wholesaling, contract assignments, if you will. And from there, I took all my wholesale proceeds and then started investing them into buying, buy and hold or rental properties. But very quickly, I realized that with rental properties come a lot of risk, a lot of headaches. Um, dealing with tenants, dealing with people destroying your property is not. I wasn't a big fan. And then I saw kind of the trend going on in the United States where the federal government and even some cases the state and local government started getting involved in habitation real estate because they see it as kind of a basic human right. So all of a sudden, flash forward, you have things going on like we saw during the pandemic where they basically said, hey, if your tenants don't pay rent, you can't evict them. But at the same time, they never said you could stop paying your property taxes or stop paying, your mortgage. So saw that writing on the wall a long time ago and decided to switch into an asset class where people didn't live in my investment, and therefore I was looking for things that I can invest in that would mitigate the downside risk to my investors. And I basically came upon a handful of assets and ended up picking self storage because that was the one where state laws were in our favor. Um, Nobody lived inside of our asset. Insurance costs were much lower. It was a lot easier to manage those from a square footage standpoint. Way less hands involved than when you invest in habitation-based real estate like apartments, single-family homes, or mobile homes, etc. And then the rest is history. And then we started picking up pretty quick. So I think 2016 is when I decided to sell all of my habitation-based real estate. And then that took about 2 years to sell everything. And then 2018, I bought my first self-storage facility. Since then, I've done 53 facilities across 24 states, about $230 million worth of self-storage.
Oh, that's amazing, man. Yeah, I can't wait to dive into that a little bit deeper. Yeah, that's massive, massive numbers, and pretty sure a lot of guys and gals who are listening will want to learn more. So with that, guys, if the questions come up, we're gonna have 5 minutes Q&A, maybe 10 at the end. So just load those questions there, and we're gonna pick up from there. All right, Fernando. So let's dive in first with a raising capital question because many of my listeners and readers of Value Builder probably are in a stage where Maybe they're transitioning from apartments. Maybe they're about that decision to sell residential, or maybe they buy their commercial property. And of course, capital is the first objection that comes in. Well, I don't have money. I don't have money, and you are the master of reframing that notion, right? So, tell me your first time when you raised capital, and how was that experience, and when did you start, and how did you start raising capital?
Yeah, so I think that we got to kind of break this down into how I was raising capital before I started treating it like its own business versus raising capital like a capital raising company, right? So
Mm-hmm.
yes, I do self-storage. I have a self-storage business, but then I also have a capital raising company that is basically its own entity that is a full-time, it's a full company in itself with marketing, investor servicing, investor relations, etc. So when I first started raising capital, I didn't really know what I was doing. I just kind of went out there with hat in hand, saying, "Hey, I got this really cool deal. Who wants to invest? You get a percentage of the ownership." But I really didn't know how to model things out. I really didn't know how to make it attractive versus other capital raises in the market at that time. And then I decided to get really serious about it, and basically put it in a framework. So what we first start with is you're usually raising, you either start with your own money, or if you don't have any money to start with, you start with usually friends and family money. So at the friends and family level, these people are investing with you not because the deal is good. They're investing with you because they know, like, and trust you. So they are giving you money because they're betting on you as the jockey, not the real estate project, aka the horse, right? So what ends up happening is very quickly you start running out of those types of capital, right? All your friends, if you've already called everyone, texted everyone,
Yeah.
talked to them on all the holidays, and they're all tapped out or they don't have a cash, available for the types of investments that you're making. Very quickly, then you have to move to friends of friends and friends of family. So these are people that you may not know directly, but they know of you. So, for example, let's say you're raising money from your parents or your brothers and sisters, and then all of a sudden you run out of that money. So now you start maybe raising from, the people that go to church with your brother, or the
Mhm.
people that are in a poker club, with your dad, etc., or with your friends, right? Again, these people are still they're betting on you, but really what they're betting on is they're betting on you via the relationship they have with the person that knows, likes, and trusts you. So these two first circles of capital, I'll call it, are the capital that you need to use to build up a track record so that you can jump to the next stage. These types of investors typically they're not very sophisticated as far as knowing what types of terms to ask for, preferred return, waterfall structures, etc. When you're talking to these types of investors, it's better to keep it very simple. Hey, Saul, if you give me
Yeah.
$1 in 5 years, I'll give you $2 back. So keep it
Hmm.
very light, you don't need to talk about internal rate of return and how IRR is a cash on cash equation inside of a net present value calculation.
Quick question. So that's really transitioning from friends and family to people you don't know, or that's still your friends group
Yeah,
typically?
so right now, when you're keeping things very, you're not using very high finance speak, these are going to be
Hmm.
your friends and family and friends of friends and friends of family.
Makes sense.
You
Gotcha.
use these guys to build up the track record. Typically,
Hmm.
on these type of structures, you can get a lot more advantageous structure out of it, and basically a lot more simple structure. You say maybe there's a simple preferred return and then a profit split, or like my first couple deals, it was just a profit split. There wasn't even a preferred return in the beginning.
Do you remember what that was? Was 50-50? What is that? Do you remember?
Yeah, yeah. So I remember my very first deal was a 50-50 deal. That was it. The guy put in the cash, we did all the work, all the profits were split 50-50. That's how it
Hmm.
was.
Yep.
Um, Now you build up a track record. Now you have a couple deals that you've either raised the capital for, done all the work, and then closed and return the profit, or maybe you haven't had enough time to return profit and they're still in process. But at least it's a track record that you can point towards when you start going to the next level. Now the next level is where I love to play in. There's a couple levels above it, which we'll talk about, but this is the level that kind of gives you the best of both worlds. And these are what we call your retail investors. So these are going to be accredited, you know, I wouldn't call them ultra high net worth, but they're high net worth. They're worth over $1 million. They have decent income coming in. They're not worried about how they're going to pay the bills. They're financially secure already. And they usually already have other types of investments. And now they're interested in creating, a part of their bucket that's diversified into alternative assets. So they already have money in the
Hmm.
stock market. They already have savings accounts. They already have IRAs and 401ks, et cetera. The retail investors, this is when you jump over that moat of people, you're going from people that know, like, and trust you to people that don't know who you are. So now
Hmm.
instead of them betting on the jockey, now they're betting on the horse. So they're looking at the deal. What does the deal look like? Did Fernando do all his underwriting? How do I know he's going to be able to do this deal according to what he's saying? Well, now you have a track record that you've built up with your friends and family or friends of friends and family to show to these retail investors. The
Hmm.
first deal or two are going to be hard to do, and typically when you're first raising from retail investors, it's where you start trying to find groups or places that only people with money are allowed to go, right? So think
Yep.
about, you got to pay $10,000 a year, $20,000 a year to be a part of a golf club. So that's going to be a great place to go. Boating clubs, yacht clubs, members type of clubs like Soho House, for example. These are places where people that are financially secure hang out, and the reason they hang out at these places is because they don't want to be near other people that don't have money, right? Because
Hmm.
they have a different type of mindset, a different type of thought. But that's only going to go so far. So let's back up a little bit. Already knowing that you're going to start raising for your first deal with your friends and family, you better start your marketing engine to start appealing to those retail investors that you'll get to eventually when you have a track record. And the reason why you want to start up front is because this type of marketing, if you want to do it the right way, it takes a long time to really catch momentum. And these are things like what we're doing right now. This can be uh, going on podcasts and then cutting up those podcasts into manageable pieces of time, 30 seconds, 3 minutes, 10 minutes, 5 minutes, depending on the social media channel, and then posting it consistently to those channels. Hey, I see I got kicked off the main screen. Is there?
No, we still hear you.
Oh, okay, there we
I
go.
think we're good. Guys, do you see him?
Okay. There we go. Yep.
Yeah, we're good.
So you want to start a marketing strategy that brings people to you because the world of capital raising is extremely carnivorous, and the people that have money will charge you a lot of money to get access to their groups that have money, right? So you're talking about your basic broker dealer, somebody that is licensed with FINRA, that has the ability to go out and find people to raise capital for deals. But these guys typically will charge anywhere between 5 to 12%. So if you're raising $1 million, there's a chance that you have to pay them $120,000 out of that million. That's a huge transaction cost. So to
Hmm.
avoid that, you want to start building organically. You want to make sure you have a great website. You want to make sure all your social media profiles are active and posting educational content about the asset class that you're going to start making money or start raising money for, right? So even if you
Hmm.
don't have a deal that's ready for now, let's say you're going to start raising capital for small bay industrial, just because you don't have a small bay industrial deal right now doesn't mean that you can't start reposting SAUL's posts about small bay industrial, or start, here's a little write up I did, 30-second video about why small bay industrial is going to be the most profitable asset class in the next 5 to 10 years, and here's the three reasons why, right? So then you start getting people that are interested in investing in these certain asset classes, but may not have enough time to do it, and they start seeing you as a thought leader. So now let's go
Hmm.
back to where we left off. So now you're at those retail investors. You already got your first couple. How do you create an engine to really get those guys coming in without a lot of work? And this is where you got to set up process and procedures just like any other business, right? Think about how are they going to reach you? How are they going to reach out to you? How do you pre-qualify them to make sure they're not wasting your time and they actually do have money to invest? And then once they are ready to invest, how do you manage that whole flow from I'm ready to invest to them wiring you the money into the deal? These all take a bunch of different systems, right? So making sure you have a good investor portal that houses all the 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 private placement documents. If you don't know what a PPM is, you need to go get a SEC attorney to start doing those things for you to make sure that you're financially protected. Go
Okay.
ahead. Yeah,
Do
you
you
have a
mind
question.
sharing, let's say, in terms of portal, what portal, let's say, guys, do you use right now?
Yeah, so right now we're using Invest Next. We
Mm-hmm.
really liked it because we started using them when the company was already, kind of small, and that allowed me to kind of shape how the products that rolled out were made so that it made sense for me. When you go to a really large investor portal company, let's say like Redwood Management or Juniper or one of these guys that they've been around for a long time, they have a set system, and if your types of deals don't really fit inside their system, well, too bad. They're not going to change the entire thing because they already have 100,000 clients using it, right? So
Makes
I
sense.
started with InvestNext probably 7 years ago, 6 years ago, and was able to grow with them as they went through all their seed funding rounds, et cetera. And the nice thing about having an investor portal is everything is compliant. You
Mm-hmm.
have your DocuSign for all the documents. You have all your wire instructions in there. You have all the due diligence documents needed in there. Your PPM, your offering, your operating agreement, your subscription docs, everything's housed in one location. And then if you ever need to look at, sending out K1s instead of emailing people K1s, which can be dangerous, you just upload them to the portal and everyone can grab them. Same thing with communications. Instead of having to call investors and telling them what's going on or email investors individually telling them what's going on, now you have this investor portal that you can publish all your updates. It's all in one location. It's time stamped and it cuts down on the amount of communication that investors need to reach you as the owner for their updates instead of having to I have over 900 investors now. It would
Oh.
be a nightmare if every time an investor had a question, they had to call me on my cell phone. I just wouldn't be able to get any work done. So that's why you want to make sure that you have some type of system that basically creates processes and procedures for you for that capital raising company. Because like I said before, you got to think about it. Capital raising is not a part of your whatever deal you're doing. It is a whole separate function, something that you could hire out for a bunch of money, or you can just start setting it up now, knowing that if you treat it as a separate company, it will be able to help you scale and raise the capital that you're looking for. So,
So quick question on, let's say, invest next. I looked at it and it just, just a couple of minutes to spend here, just from technical standpoint. Um, if we wouldn't go back to the first step when we start raising money from friends and family, and some of them they're gonna be only loans, not equity investments. Can you manage also loans and mezz debt, let's say, stacks in invest next?
you can, yeah. So it's very, very easy to set up how the hurdles, if you will, work. So the way that you set up a debt instrument is kind of the same way you set up a pref equity investor, right? They're getting
Mm,
paid a simple interest or amortized interest on a deal each quarter or each month, however you set it up, and it's all housed in there. Now you got to be careful because I've seen a lot of investors setting up their investors as, let's say, debt, so they say, oh, I don't have to file a ppm. Well, it's not true. You have
yeah.
to make sure that there's something called the Howey test. It's 4 questions. If the answer to those 4 questions is yes, regardless if you're calling it debt, if you're calling it equity, you have yourself a security, which means that you need to file to protect yourself. It's not to protect your investors, it's to protect you as a sponsor from getting in trouble with the SEC. And the SEC is one of those industry or one of those departments that they can send you to prison for 30 plus years and millions of dollars of fines. And there's no excuse of, well, I didn't know I was doing it wrong, right? So you have to make sure you're talking to an SEC attorney that helps you can set up these syndication documents.
Now, so do you know by any chance those 4 questions? Meaning the questions would be whether that's a loan or that's actually already syndication, right? That's
Right. Yeah. So if you look at the Howey test, it never in the Howey test does it ask you if something is a loan or not. What it
okay.
asks you is these 4 questions on how the deal is done and how are the profits split. So I'll pull it up here for you to see the
Yeah.
4 questions here. So here is the Howey test.
Okay.
All right. Is there an investment of money? Question one. Doesn't say is it debt or is it equity? Is someone handing you money? Answer
Yeah.
yes.
Okay.
Is there a common enterprise? AKA, are there people pooling their money together for an individual deal? If it's
Okay.
equity or debt, doesn't matter. If you have multiple lenders on a one deal, the answer is yes, correct?
Mm-hmm.
Are the profits because of the efforts of others? AKA, they are silent partners or they don't
Yeah.
do anything. They
Mm-hmm.
give you the money, you do all the work, and then you give them profit back, right? Doesn't say if
Yep.
it's interest or if it's equity, right? So the answer is yes if it's debt still. And then the
Exactly.
last question is there a reasonable expectation that profit will be made? Do you tell these investors that they're going to make some type of return on their money? It doesn't matter if it's interest or if it's equity. The answer is yes. So if you answer those four questions as yes, that means that you have yourself a security and you need to file with an SEC attorney. So it
Mm.
doesn't matter. So if you have, let's say you go do a deal and you set up only as debt, you only have lenders, but you have two lenders, one is your mom and one's your uncle, you now have yourself a security.
But let's say if my mom goes in the first and uncle goes in the second position as a mezz debt, do you think that's security or that's first and second?
So this is a good question for a SEC
See
attorney. I'm
attorney.
not an attorney, but the way I'm looking at it is if there's not in a common, level, then if there's someone on a first and someone on a second, I think that that's fine because
Mm-hmm.
they're not part of that common enterprise, if you will, right?
Mm-hmm.
So that may work. Again,
Makes sense.
talk to an attorney before you do anything. You want to make sure that you're covered. Again, this is to protect you. So, it's worth whatever it costs, 5 to 10 grand to set up a PPM as opposed to doing something wrong accidentally. Someone gets pissed, they talk to an SEC investigator, and all of a sudden now you're looking at 30 years in prison, right? You got to be
That's
very careful.
awesome. So, all right. So I think we're going really towards the syndication level or syndication structure. I think for me personally, always was the question, and I know people industry going one route, another route, uh, when to start the fund and when to keep doing syndication individually. So I think the question
Right.
to you is, are you pulling everything in one fund, spreading the risk, or are you still isolating the risk per project? No, maybe you can give your perspective.
This
I've
is,
I've heard
yeah,
many opinions, but where are you
yeah.
at?
So this is a great question and kind of aligns with kind of the next level of capital that you can get. So once you have your money from the retail investors, then you start going towards these ultra high net worth family office, wealth manager slash registered investment advisor route. So these aren't necessarily institutional investors yet, like your pension funds, et cetera, but they're sub institutional. These guys typically have minimum check sizes that, depending on the type of deal you're doing, their minimum check size is larger than your entire capital raise, right? So here's
Mm-hmm.
an example for me. The largest self storage deals that I build, I usually need to raise $5 million in equity on those deals. But I have a few family office clients that say, Fernando, our minimum check size is 10 million. So we can't invest in your syndications because it just doesn't make sense from our, internal underwriting standpoint. So this is where you start using the experience that you built up with your retail investors using single asset syndications to then move into the next level if you want, which is the fund model.
Mm-hmm.
And there's pros and cons to this. So pros are now you're starting to get access to people that have larger check writing capability instead of, you know, having people chuck in 50 to $100,000 and to raise 5 million. Now you got a ton of investors that you have to deal with. The second pro is that you also have the ability for something that's more programmatic. So instead of having to constantly wait till a deal is ready to go, and then all of a sudden the bank says, okay, we're ready to close in 5 weeks. You have 5 weeks to raise all the capital. Now you may have someone that says, hey, I have a $20 million bucket allocated to you. Spend it through the next 3, 4 deals, et cetera. The cons are typically the people that write these types of checks way more sophisticated. And based on the way they have these complex waterfall structures, they're going to want you to take the majority of the risk and they're going to take the majority of the profit. They're going to want you to invest at least 10% of the LP money that you're raising yourself, called a co-invest. They're going to want you to take all the risk up front. They get a preferred return. And then the waterfall, instead of it being like a simple retail investor waterfall that may be like a 8% preferred return and then a 50-50 split, or 8% return and then a 70-30 split. They'll go off with a, 90-10 co-invest, then a 10% pref, then a 95-5 up to a certain IRR, 12%. Then after 12%, they want a 90-10 up to 18%, and then a 85-15 up to 22%. So they're keeping a lot more of the profit, and you're basically taking all of the risk
Mm-hmm.
yourself. So that's one of the cons of using these types of guys. Now, when it comes to investors, there's people that have different preferences. Some type of investors only want to invest on single asset syndications because they want the ability to underwrite every deal before they give you the money.
Mm-hmm.
And then they'll do the diversification themselves. Versus then you have some type of investors that they only invest in fund models because they don't want to bet on one individual horse that you have. They want to
Yeah.
bet on the entire stable of horses that you have. And if one falls or breaks its ankle, you got another nine that are doing all right, right?
Mm-hmm.
So what I like to do is actually do a hybrid model where I
Okay.
have a fund. That fund is what we call a co-GP fund. And that fund has the ability to co-invest on every single asset syndication that I do as a GP. So I will throw in 10% of my money, another, 30 to 40%, let's say 40% of the money comes from my co-GP fund, which means that when I go to raise capital from the LPs on that single asset syndication, I'm only raising 50% of the equity stack as opposed to say 90 or 100% in some cases, which means I can get a much better waterfall on the single asset syndication itself, right? Which then further benefits the GP as well as, me being a GP on the deal versus as well as me being a GP on the fund level. And
That's
that makes
gold,
it a lot.
man. That's amazing. I hope everyone got it. Just want to make sure, guys. Did you get it? How are you structuring that? Just,
So let me rephrase to make it
I think it
easy.
was, maybe for someone, it was just for me. It was just like gold. We just told. All right.
Yeah, so let me rephrase how that works. So you have your single asset syndication that typically most people invest in. They can choose to use the deals.
Mm-hmm.
You have a fund that is a GP fund, which invests next to you as the general partner into every deal. Because now you have a couple things working in your favor. If you have an investor that only does funds, fine, you have a fund. You have guys that only do single asset syndications, fine. You have someone that does single asset syndications. But when you invest with people in the single asset syndication side, because you basically, in the eyes of the single asset syndication investors, you're bringing 50% of the entire equity stack to the deal, which shows that you have a lot more skin in the game. But what they're not seeing, or they can see, but 40% of that 50% is other investors that are at a GP level fund where they're able to invest across all your deals. So now you get better waterfalls on the single asset syndication. You get more profitability to the fund level, and you stop with these types of questions where sometimes you have these larger LP investors that say, "Hey, I'm going to invest with you, but for me to invest with you, I need GP economics." Even though I don't
Mm-hmm.
want to do any GP work, all I'm going to do is give you money. I'm not going to sign any balance sheets. I'm not going to do anything. So this allows you to say, yes, you get GP economics, but you're not giving away all the ownership like you would have in the first case if they were getting economics just on the single asset syndication. So it's a
Yeah.
hybrid structure that allows you to do whatever you want.
Now, let me ask you. So, isn't that almost the same, just different semantics? That if you have that fund who invests, called in simple words, in your down payment for individual property LLC, it's almost like a legal mess that structure, right? Or
Correct.
no?
So then the bank won't see, you won't get any problems with banks to say, hey, we don't allow mez debt. You say,
Exactly.
that's totally fine. I have no mez debt.
Yeah,
I'm
because
coming in with,
there is no fuse on repay that.
right,
Wow, this is
exactly.
just genius. I told you, Fernando, just have those golden nuggets. They're gonna, I'm gonna keep thinking right now for 2 weeks about this. Amazing. Keep going.
Yeah. So the nice thing about this is usually people that invest in funds, they don't want to invest in your first fund that's your first deal as well. So typically, you don't want to start with a fund right out the gate. You want to do a couple single asset syndications, and you want to make sure those single asset syndications have gone full cycle. So you raised the money, you did the value add, you sold the asset, and you return profit to your investors. That's going to be the most important thing to those fund investors. Okay.
Hmm.
After you get to that point, now you have the ability to scale a lot faster. You have the ability to raise much more cash and without a time limit. Because the nice thing about a fund model is you can get soft commitments. So they've already signed the document saying I'm going to give you $1 million. But then instead of having to pay pref on that full million, let's say you only need 200,000 at first, you get to call 200,000 of capital, and you only pay pref on the money that you're using, and that way you're not scrambling to find equity when you're going to go get deals. This also helps for, when you're dealing with sellers, where a seller says, "Hey, I'll give you a good deal, but for this good deal to happen, you have to close in 30 days." And sometimes,
Yeah,
most of
that's
the times,
another one
banks
thing I want to
can't do it.
emphasize, and I've heard from many people who don't want to go to fund model because yeah, the checks are so large. I have only, $5 million in projects, and family office wants to write me 20 or 30. It doesn't mean you have to take always 20 million. You just take, it's a line of credit technically, and you pay only what you have to demonstrate capability that you're going to be able to deploy that 20 million a year or something like that, right? So
Right, exactly.
that was for me also a block, and I saw other people why not transition this. I just want to emphasize that.
Yeah, so that's the ability to call capital is one of the things that really helps. So typically what you want to do so that their investment is secured is you say, okay, you're saying that you want to invest a million or 10 million, doesn't matter. Whatever you want to invest, you have to deposit 10% of that into our account for our current deals or deals that we're about to close. And then once we're ready to call the other 90% or other 50%, et cetera, whatever it is, you have X amount of days to deposit that amount. If you don't, that original deposit you do gets diluted. So this is a lot of people say, oh, well, I don't want to call capital. I want people to invest all the money right away because what if something changes and then they don't have the capital to give to me 6 months down the line or 1 year down the line? This is how you incentivize people to not do that. You know, you have them call capital and whatever they're unable to, they get diluted if they don't put the capital in that they promised based on their subscription agreements.
Okay. So it's super much so deposit of 10%. So when you so commitment is 10%. That's what you're saying, right? When they commit, they have to commit to with 10%.
No, so the commitment is the full amount. So let's say Saul wants to invest in Fernando self storage project. You say, I got $1 million for you, Fernando. I say, great.
Mm-hmm.
I don't need your full million right now because I got a bunch of other investors that also got $1 million for me.
Mm-hmm.
What I need is only 10% of that right now. So you
Mm-hmm.
sign the commitment document at $1 million, but then you have to wire 10% of that into my account right now. And in
Correct.
the subscription documents and in the PPM, it states that once I'm ready to call the rest of those funds, if you are not able to wire me those funds within a certain period, whatever you choose, 60 days, 90
Mm-hmm.
days, what have you, then your original 10% that you wired in, that amount gets diluted down.
Diluted in the shortage that need to raise, right?
Correct.
Okay,
Exactly.
makes sense. That's
So
genius.
that's one way
Yeah,
to keep people from spending the money they already promised you, right?
amazing. And is that kind of industry standard? Because I did not know that. Will family office will sign this type of doc?
Yeah, yeah. Yeah, yeah. Industry standard is, especially when you're raising large funds like this, um, it's actually very uncommon to have them wire all the money to you right now. That's extremely uncommon. It's typically the most common thing is that there's some type of deposit that gets sent in to secure your position, and then the rest of the capital will be called when needed over the what they call the investment period. So, my fund is it's a 1 year investment period. I have the ability to extend it for another year. And then anytime in that 2 year period, let's say, I can call all the capital. Let's say at the end of
Mhm.
that 2 years, I didn't call the capital, then I no longer have the ability to call the remaining capital and use that dilution structure. So it just depends on how your docs are set up. And again, this is one of those things that you should not do alone. Please promise me that you will go get an SEC attorney to make sure that you're doing all this legally, that the documents spell out exactly what you're allowed to and not allowed to do. This is going to protect you. It's 5 to 10 grand. That is the most well spent money you can do on any deal.
Yeah, absolutely. 100%. I can vouch for that. No, just, yeah. If you're doing PPM, just make sure you don't do it with ChatGPT. Make sure you hire an attorney.
Right. And so
100%.
this brings me kind of to a second point here is how do you know how to structure the waterfalls and the returns, et cetera? Well, there's no golden rule. The market changes, just like how when properties go up and down, it's based on comps. So how do you find comps for syndications? Well, There's some really great websites for crowdsourcing that you can go to, Fundrise and PropRise, and there's some other ones that you can go to, and you could see what current syndications are going for, and you could see, okay, well, they're promising an 18% internal rate of return with a 5 pref. And then after you start seeing like 10 or 20 of the ones that are in your field or closely related to your field, then you start to see where the range is on what you should offer. And then you got to look at yourself based on your experience versus the people that are raising. If all the numbers you're seeing are from people that have the same type of experience as you, then you should probably use an average of those numbers. If you have more time to raise, get a little bit more aggressive. If you have less time to raise, give more away. If you notice that everybody that's out there with these comps on these PPMs have way more experience than you, 10 years experience, et cetera, then you need to set your returns to be risk adjusted compared to theirs, which means you need to offer more for the investors than what they can get with somebody that has more experience. And that's typically what you see. As syndicators get more and more experience, their IRRs start coming down, their prefs start coming down, the amount of fees they charge start going up. So if you look at like a PPM from Blackstone, for example, one of the largest real estate funds in the world, you see that their internal rates of return are like low teens, 12%. There's basically no preferred return, and their fee load is like 11% of the deal gets paid out in fees day one. That would be insane for us to try to do, right? For example, if you want to look at me, I've been doing real estate for over a decade. I've been doing syndications for 7 years, over 7 years. My fees are typically no more than 3% of the total deal. In some cases, they're 1% of the total deal. And my internal rates of return for, let's say, the most risky stuff that I do, which is ground up development, that's in the 22 to 27% range. If I'm doing stuff for like a value add that doesn't need any construction, it's all soft value add, it's already got cash flow producing, distribution start day one, then I'm more in that like mid to high teens, call it 14 to 18% internal rate of return. So you can kind of
And
see
what
what
is your
my range
deal
is.
cycle, typical deal cycle, typically, in terms of years?
Yeah. So the longest I've ever held a deal across all 53 of my deals was 4 years and 2 months. The shortest I've ever held was 13 months. And my average is 3 years and 5 months. I know these off the top of my head because I have to look at all my numbers because these are exactly the types of questions that your LPs are going to be asking you. So you got to know what's your average return? What's your, how long's your deal cycle? What are the fees that you charge? You need to be able to know this off the top of your head.
Makes sense. Now, when you said no, 1 to 3% your fee, when you say on a total deal, is that on a total cost basis, on that's on equity portion?
So that is on the total deal size is typically how we look at it, but the way that they're actually calculated is on different things. So for example, we may charge a 1 to 3% acquisition fee
Mm-hmm.
on the purchase price of the asset, right? So let's
Mm-hmm.
say I buy land for $500,000 and I'm going to build a $14,000 or $14 million facility. I'm going to get, 1 to 3% of that 500,000. But then I also will charge 3 to 5% of a construction fee on or developer fee on the construction, which will be just the hard costs, right? So if I'm going to spend 10 million in hard costs, I may get a fee of 300,000, maybe 500,000. When you add up all those fees, you can also look at what is your asset management fee. Maybe you charge
Mm-hmm.
1% per year, paid out monthly. Take all those fees, add them up, and then put them over the entire project cost, the total deal size, to see where you fall.
Mm-hmm.
In the beginning, you want to be extremely fee light. As you
Mm-hmm.
start getting more experience, then you can start upping your fees because fees are not supposed to be profit centers. Fees are more
Yeah.
supposed to be to help you keep
Best.
the lights on. So
Best.
as you
Yeah.
start hiring more staff, as you start hiring more people, you're going to have to pay CPAs, you're going to have to pay construction managers, GCs, all this other stuff. That's what those fees are there to help pay for.
Mm-hmm. Makes sense. Makes sense. Yeah. That totally makes sense. Now, when talking about the fees and the structures, what I've seen lately, and especially that blew up a lot of operators who were modeling Blackstone promises, but at the same time, yeah, there is manager's experience, but it's not only how long you were in the deal, in the deals, but that structure has to match your deal. Meaning,
Right.
what I see people get in trouble, they chase and they overpromise LPs what they can pay out, and then eventually the deal blows up just because deal cannot support that. So can you talk to that? Meaning, of course, there is always tendency a
Yep.
little bit no stretch to the most optimal scenario, right? If I will try to qualify the question is no, how do you stretch that optimal or optimistic promise, but still stay on the side that you don't overpromise when your
Right.
deal blows up and you cannot fulfill the promise, 3 years down the road or 5 years down the road.
Yeah. Yeah, so I had a really great meeting with a family office a couple years back, and the guy's
Mm-hmm.
question was great. He said, I want you to put away all your material so you can't see it, and I want you to give me three one-sentence answers. What is the worst case scenario? What is the best case scenario? And what is the most probable case scenario? So I said, this is a great question. I wasn't prepared for it, but if I had to go off the top of my head, worst case scenario is you lose all your money. So that's always the worst case scenario. Never have a worst case scenario that is less than that because then you're lying. Because you never know when, God forbid, Chicago gets hit by a hurricane or there's an asteroid strike. It could wipe out everything. So truly worst case scenario is they lose all their money.
Yeah.
Best case scenario, that's going to be what you'll see as internally what you'll see as what you're really underwriting to. And then most probable case scenario is the what you should put into your PPMs to your investors. Why? It's always better to underpromise and overdeliver because the easiest way to find more investors is to have investors that are happy with you tell their friends. Everybody, when you're thinking about your high net worth investor, think about a guy at the country club. They just got done with a round of golf. They're having dinner with four or five of their best friends, and they start bragging about the returns on their investments. You want to be the guy that said, Fernando told me I was going to get 12% return, and here I am. He paid me out a check. I'm at 33% internal rate of return, right? That's how you get almost instant new investors, the easiest way. The
Yeah.
when you do something right for somebody, they usually will go tell one to three, maybe four other people. When you screw somebody over, they're going to tell literally anyone that's willing to listen to them. 100, 200 people. So you may have the urge to stretch your investments, your IRRs, your equity multiples to try to get more investors, but that's short-sighted. It's always best. So for example, like I just gave you guys my range, mid-teens all the way up to high 20s IRR on all my deals, right? My actual results, I'm in the 50 to 220% internal rate of return. I don't even show that to my investors unless they ask for the actuals because it's almost unbelievable when you tell them, oh, well, I'm hitting 50 plus IRR.
Mm-hmm.
Tell them what you model to. So always, you're always going to have what's worst case scenario, you lose all your money. Best case scenario, which is going to be your true underwriting, but that's not what you're going to put on your PPM docs.
And
You're
bring it
going to
down.
scale everything back down by 5 to 7% IRR because then
Mm-hmm.
if something goes even like a little bit wrong, you still got a bunch of cushion where you know you said you're going to give 12% IRR. Here, let's use an example I have. For example, I said I was going to give 18% IRR on a deal that I underwrote that I knew was going to actually come back at 24, and then lo and behold, we had some problems with construction. We had maybe 2, 3 months delay in construction. But when we finally got that deal paid out to the investors, instead of getting 24, which I knew was my internal underwriting numbers, and they were expecting 18, I was able to pay out 21%. So
There you go.
21 on 18, that's a huge win. 21 on 24, all of a sudden I'm the biggest bad guy in the room because I overpromised and
Yeah.
underdelivered, right?
Yeah, I want to drop here actually a couple more things. So I know a friend, Brian Overly, and they're a huge apartment operator, and he's my triathlon buddy. He has in his procedures, and it's probably 20-year-old firm. What they do, they always pay 1% more when they do payouts, even though they PPM docs, let's say, call 7% or 8% per. When they pay outs, they pay 1% more. It's just kind of a given,
So smart.
and then they never have to chase money. They have always oversubscribed. And another thing, for example, just whoever is listening, coincidentally, I just refinanced my first syndication deal we bought 5 years ago during the code bus terminal, and it was $6 million deal. I think raise was like 1.2, and we just refined our money, got the money back from the bank. And Ruta is right now on the call. She's our accountant, and she did the payoff letters, and I sent out the payoff letters that I have to sign, and I'm receiving the money on Friday. Guess what? Everyone, including 100% of them, already called me back. Is like, can you put the money back? It just as soon as you give them the money back, they're gonna keep it for one day and then put it back into work. So it's really how funny it works. They usually they investors they demanding, they asking where's the money, how soon, how the project's performing, but as soon as they give the money back, they want to put it back again.
Right. And
So
so this goes back to what we talked about setting up a procedure, setting up a company that, in the beginning, when you're raising capital, it's a lot of work. It's a lot of work. So, how do you set up your deals in a way that makes every time you go out to raise a deal, you have to do less and less work to get the same amount of money or more money? And this is one of the strategies, right? Under promise, over deliver. Then all of a sudden, you have a super high reinvestment rate. So, instead of having to go out and find a new $5 million every time, maybe the second deal 3 million of the five that you did on the previous deal already reinvested. Now you only have to go make calls for 2 million. And then on the third deal, maybe four of the five, and now you have to make calls on 1 million. And then you eventually get to a point where we're at now where you get people that are oversubscribing. I have 5 million that need to raise. People put in 5 million from the previous deal. Plus I have another 2 million that people that wanted to get into that same deal. And I say, listen, I'm so sorry. Let me put you on a wait list and for our next deal. And then they make that now it drives your investors to work faster on the underwriting to make sure the deal makes sense because they don't want to miss out on the opportunity. They're ready to go, and they're not going to be causing a lot of questions, concerns, et cetera, because they've already invested with you. They know how you work, right? So you got to think about it from the investor experience. It's one thing to raise money, but the most important thing is your investor relations or what you do after you have the money. How do you make sure that you're communicating on a regular basis? You're getting them K1s when you promised. Uh, you know, ideally they don't have to file extensions. They can find everything very easily in one place, aka why you need an investor portal. If someone says, "Hey, where's my K1?" It's in the portal. Well, what happened on the deal? Check the update in the portal. Everything's there. It's all in one location. You got to try to make this as easy as possible because, like I said, it is a full-time business. So it's a separate business from the actual business that you're doing. It's just raising capital.
okay, awesome. All right, so I think let's do one or two more questions and then we'll go to Q&A. So guys, get ready with the questions. To ask to Fernando. What I would like also to know from a technical aspect on the fund side. So, do you guys, when you go in acquisition, do you close cash with funds money and you pull the money, or you do a typical structure still close with debt and equity? What's your process typically right now when you already have a fund?
Yeah, so it really depends on, is the seller gonna offer a discount for closing all cash?
Mm,
Uh, that's one. Is it a type of asset that would benefit from closing equity first to get it to a more stabilized position so that you can get more advantageous debt later on? So, for
mm-hmm,
example, let's say you go buy a heavy value add deal, it's 80% vacant. No bank is going to want to touch that. And the banks that are willing to touch it, or the lenders, I should say, most banks won't touch
mm-hmm,
that. But the lenders that are willing to touch that, they're going to be charging you very high interest with high points. So maybe that's a situation where you close all cash, do 6 months of value add, get it so that it's operating well, and then go to a bank. Same thing if you go buy from a seller that has no books, right? This has
mm-hmm,
happened to us multiple times, where the seller either had no books or was lying on their books because they didn't want to pay tax every year, so they underreported income. But the bank is only going to give you a loan based off of the tax returns from the seller, right? So maybe you need to close cash or a combination of cash and seller finance to then create the books or correct the books that were fudged in the beginning to then be able to go get much more advantageous debt than you have right now. And then it
mm-hmm,
also, another thing that you should look at is how much money do you have in the fund versus how much you have the ability to deploy. You can have two issues. One is you don't have enough money in the fund and you need to use a lot more debt until you can backfill with that equity and then lower your LTV or your LTC. Or you can have the opposite problem where you raise too much money, but you don't have enough deals to deploy that money. So what you can do in the medium term, while you're buying yourself more time to buy deals, is you close deals cash. Then once you have a deal that makes sense, then you just go refinance, or you do what we call like a delayed financing
Mm,
structure, and then
wow.
get your cash out to then go and do your next deal.
That's amazing. That's another golden nugget for the fund. Yep. Wow. But it has to be yeah, you can't do it really in syndication. It has to be on the same ownership under the fund structure, right? You cannot just put from one syndication to another syndication that money. You cannot commingle that way.
That will, yeah, you can't do that on a single syndication structure, but on a fund you can because all the money is
Hmm.
spread across the basket of deals that you have available to that fund.
That's amazing. That's amazing. I think we have one question for one more thing. I know there was someone that's asking for the recording, so so at the end, we will send out an email with a feedback request. So someone, everyone who's gonna sign up for that and we'll put the feedback and testimonials, if we can, we'll get a recording as well. So last thing I wanna ask you, Fernando. So right now, when you have a fund structure, do you have roughly what LTV you are buying, or is that really still deal by deal basis, or do you like to stay, let's say, mostly 60 or 50% LTV when you're putting debt on it, or it's on my end. Typically, my deal is a 75-25. We have we're trying to push the debt as much as possible, not as much as possible, but to stay, with DSR levels like a 1.5, 1.25, but we're trying to push that higher if possible. Where are you at right now?
Yeah, so this is a great question. So you got to realize, on a single asset syndication, the people that like investing in those single asset syndications, they're investing because they want to be able to do due diligence on every given deal to see,
Mm-hmm.
hey, maybe Saul's putting too much leverage or maybe he's not putting enough, et cetera. When people invest in a fund, they don't usually want to invest in a blind fund unless you got 30 years track record, which most
Mm-hmm.
people don't. So you have to set up parameters that you have to stay within to invest in that fund. And the tighter those parameters, the more willing fund investors are to give you money. Because a fund investor doesn't want to give you money assuming that you're going to use 65% debt. Then all of a sudden, in their quarterly update, they see that a deal popped up that had 100% financing, right?
Mm-hmm.
That's a big no-no.
Mm-hmm.
So, for example, on our fund, we have a range and we say for what type of deal. If it's a construction deal, we're going to be shooting between 65 and 70%
Mm-hmm.
LTC. But we're able to go lower if we need, right? Not
Mm-hmm.
higher, but we're able to go lower on leverage if we need.
Mm-hmm.
If it's a value add structure, uh, our range is, let's say, 50% to 65%. So the exact percentages don't matter. All that matters is that you have a structure that's in the fund docs that states exactly what you're going to do or within what type of parameters you're going to do. And if a deal presents itself that does not fit that parameter, you are not allowed to shove it into the fund because that is not what those fund investors agreed to when they initially gave you money, say 1, 3, 5 years ago, right? You can't change it unless you put it in. You have to put the parameters that you're allowed to operate in within that fund. If you don't do that, you have now what's called a blind fund. And blind funds become way more difficult to manage because of compliance. You have to file them under different types of exceptions and regulations under the SEC. You may have to start doing mark to market. All these things cost a bunch of money. You don't want to do that. So I don't think anyone on this call is ready for the point to go to a blind fund model. I'm not ready for the point to go to a blind fund model. I probably won't be for another 10, 20 years. Don't do that. Have very set parameters on what your fund is going to do.
Makes sense. Makes sense. All right. So I think next, Fernando, do you have a deal right now that you're raising, or do you have a where people can find you if you want to present them a deal, and then we're going to transition to Q&A after that.
Yeah, so we're always raising capital. We have a pretty robust deal sourcing model or engine. The current deal that we're raising capital for right now is in Lawrenceville, Georgia. It's a affluent suburb of Atlanta. It's a ground up development. We already started on the construction already about a month and a half ago. There's, I think, only about 1.5 million of space left out of the 5 million that we're raising on that deal. So if you want to find out more about what we're doing or you want to connect with me, two easy ways to get a hold of me. One is to go to our website, which is ssse.com. So samedward.com. You can go fill out a contact information page right there, and I'll give you a call back. Or if you're someone that's a little bit more aggressive on the outreach, you can just give me a call. Here's my cell phone. My personal number is 630-408-8090. You can call or text. Text is usually a faster way to reach me, all right?
Amazing. Amazing. All right. So now we have time for probably a few questions. Guys, if you have a question, please raise a hand. I see there was one question from Joe. Joseph, I think you had a question. Are you available right now? I see you muted right now.
Oh
Joe?
yeah. Hey, yeah, this is great
Hey,
information. I
Joe.
wish I jo
Yeah,
Hi,
so
how you
Joe,
doing?
tell me where you're from and shoot to the question.
Yeah, sure. I'm in Danville, California. Sorry for the background noise. Yeah, we do syndications primarily in retail shopping centers, and yeah, my question has been customized. I mean, obviously, there's advantage and disadvantage of funds. You know, we're a little bit new in it. We do syndication mainly, and so we've been looking at funds. But one of the things that interests me about this concept called customizable fund, I'm not sure if you can talk about that, but it allow you to do multiple deal on one fund, so 1K1 and among other things. Are you able to talk about that? Do you have experience in that maybe that you can maybe talk to pro and cons?
Yeah, so you're talking about a structure that's more of like a series fund, right? Where you can, let's say you have a fund and then you only raise for each individual deal within that fund. Is that kind of what you're talking about?
Well, the advantage from an investor perspective would be that as the investor invest into your fund, they can choose what deal they want, to invest in, rather allocation of their fund. But the key advantage is that they will only get 1K1 through that one fund. So I'm not sure if that would be similar to what you've been sharing, or that's completely different, I
Yeah,
guess.
that's a very interesting model. The way I look at that, it's not really a fund, right? Because if the investor can choose what they want to invest in, then you're basically doing single asset syndications by any another name, if you will, right? So I have seen some people do this type of structure. I get what you're saying. I personally am not a fan of that type of structure. So what I decided to do, like I said before, is we have our single asset syndications, and then we have a co-GP fund that invests into every one of our single asset syndications. That way, we have the ability for investors to choose whether they want to invest into a single deal or they want to invest into a fund. It makes it a lot cleaner. And the cleaner a fund structure can be, the easier it is to attract larger check writers to that fund. So if it's anything that's kind of out of the norm or they don't know how to feel about that, I personally would not do something in that type of structure. I'd rather do the type of structure I'm doing, which doesn't cost that much extra. You know, each additional syndication I need to do is maybe 10 grand underneath the fund, and that's fine because then that gives me the ability to raise a lot more capital than I would if I had to choose one structure or the other.
Great, thank you.
All
Appreciate
right.
it.
No problem.
Awesome. Thanks, Joe. Appreciate it, buddy. All right, we have a second question, I think, from Miss Young. I hope I'm not butchering the name. Are you available? I see you muted. Um, the question was, what was the worst deal you was what was the worst deal you've done in self storage? Are you available, Young? All right, so I'm just gonna ask the question for them. So the question was, what
Okay.
was the worst deal you ever done in self storage?
Yeah, knock on wood. Because of my conservative underwriting, I haven't yet to do a deal that has come below projected returns. I did do a really bad deal in multifamily a long time ago when I first started, and that was one of the reasons why I decided to get out of that asset class because we had a lot of inherent risk that came from the municipality, that came from the tenants causing a lot of destruction. So if you
I
want to
remember
learn
that deal,
about
by the
that,
way.
yeah, if you want to learn about that deal, I went on a podcast called How to Lose Money, and I talked for 45 minutes about that deal and how I lost money on that deal. So just Google my name, Fernando Angelucci, and podcast How to Lose Money, and you'll hear me talking about that bad deal.
Awesome, awesome. All right. we have a question from Neil Henderson. Are you here, Neil?
Hey, Neil.
Hey, Fernando.
How you been, buddy?
Good. How are you?
I'm doing
Good
good.
to see your,
Good to
good
see
to
you.
see your face as always.
Likewise.
And on your GP fund, does it have different terms for the LPs from the single asset syndications?
It does, because that fund is what we call a diversified self-storage fund. So not only does it get access to um, the profits from those single asset syndications, but it also gets profit share for all the other business activities we do. So, for example, wholesale deals, it gets a portion of the profits from the wholesales that we do. It gets a portion of the profits from the pref equity and the first and second position that we do on our own wholesale deals to our buyers. So, for example, somebody buys a deal from us, they say, "Hey, Fernando, I'm short 300,000. Can you take a pref position because my lender won't let me take a second?" I say, "No problem. It's 12%, point in, point out." And then the fund gets a portion of that profit as well. So yeah, it is different terms. The reason we set it up as basically a fund that encompasses our entire business is because we've had a lot of check writers that said, "Hey, Fernando, I'm not interested in investing in a single asset syndication. I want to buy a portion of your company, Triple SE. And I am never going to give away a piece of ownership in my baby. So I'm going to give you the next best thing, which is a fund that gets access to everything we do inside of our company."
Yeah, that's amazing. That's another mic drop comment. Wow.
Got it. Cool. Thanks, man.
Thank you, Neil, for the question. All right, I think we have time for the last question. John Goodrich, what's up, buddy?
Hey, man, how are you? So, Fernando, I feel like I may be a little bit of an anomaly on this call. So, I am exited residential wholesale and rehab, had some great mentors in that, and kind of been on the periphery of commercial. So, I am fire hosed into a fairly heavy lift, large project for about 8 months now in management. What's your recommendation for someone kind of like that to go out and find money? Like, where do I start with that?
Yeah, that's great. So, when I switched asset classes, I leaned on my track record in the other asset classes when I first started going to self storage. So that made the first capital raises actually a lot easier than I thought they're going to be. I was really worried that investors were going to say, "Hey, great, you did all this awesome stuff in residential and apartment buildings and Airbnbs, et cetera, but I don't see anything on the self-storage side." And then I just showed how the same skills translate into self-storage. So I said, "Listen, how I source deals, exact same way. Our marketing engine is built the same way. We just change the names on the letters and on the call scripts, etc. My wholesale, my disposition list, I'm going to build it the same way I built it for multifamily guys, but now it's just self-storage buyers, right? How I structure pref equity, how I structure first position debt for my wholesale buyers, the exact same way I'm going to do it for my self-storage buyers. So everything's the exact same. And then in the areas where I may not have a lot of experience, like say managing my first self-storage facility, I would find ways to mitigate that risk by borrowing credibility from other people. So how do I borrow credibility? Listen, I've never managed a self-storage facility. That's okay. I'm hiring, let's say, Extra Space Storage, who's the #1 self-storage third-party manager in the world, to operate my self-storage facility. That's the way that I'm mitigating my inexperience in management. Or let's say I have never done construction on a construction project, a self-storage construction project, but I've done it on multiple single-family homes and apartments buildings. Fine, totally okay. Meet my construction manager, Eric Platt, who's going to oversee all of the GCs. He works for me, not for the GCs. He's going to make sure he keeps them in line. And Eric has built, $300 million worth of self-storage. So that's how I'm mitigating my inexperience, by borrowing credibility from my team members. So that's what I'd recommend that you do.
All right, appreciate that.
Amazing. All right, so before we wrap this up, I want to plug in that everyone on this call, after that, we'll get an email with feedback. So please, if you can, take a minute of your time. We try to do it every month. As you imagine, to pull people like Fernando, it takes a lot of time and work. I think it was probably 3 or 4 months in work in the makings to get the time when he's available and when we can time it right. So give the feedback what you'll want to hear next time. What guests should I pull or try to attempt to get him on? And yeah, the goal is just to bring as much value as possible. Thank you for reading Value Builder newsletter. And also, there is going to be another questionnaire if any one of you want to attend the Small Bay Industrial Bootcamp. The next one in June, it's sold out, but probably going to do another one by the end of the year. So that's my ask for you guys after this webinar. And everyone is going to get the recording. Me personally, I'll still rewatch it because Fernando, like always, dropped 3 or 4 golden nuggets. I've been in this business for 20 years, and this guy still comes up with some nuances that I never thought about. So I really appreciate Fernando for all your wisdom, for your knowledge, for sharing that. Like always, you're not holding back. You sharing. That's who always you did, and I'm so privileged to know you and keep learning from you. Any last words from you, man?
No, I appreciate everybody spending the time to, watch us chit chat here. And like I said, if you guys have any other questions that maybe just didn't come to mind during the webinar, and you wanna all of a sudden we jump off, you're like, oh man, I forgot to ask Fernando that one thing. Like I said, feel free to go to our website, ssse.com or samedward.com. And then if you want to reach out via text or call, it's area code 630-408-8090. All right.
Amazing. All right, guys. Thank you all. Thank you, guys. Appreciate that. Thank you.